Hello everyone. In this video, I will be talking about how a specialness of financial institutions lead to increased regulation, and we'll briefly discuss about some regulations that financial institutions are exposed to. In the previous videos, we have discussed that the financial institutions are special because of the various services they provide to all sectors of the economy. Failure to provide these services or a breakdown in their efficient provision can be costly to both ultimate sources, for example, households and users of savings. The GFC that commenced in the late 2000s is a prime example of how such a breakdown in the provision of financial services can cripple the financial markets worldwide. The negative externalities affecting farms and households when sometimes gone wrong in the financial sector of the economy provides a case for regulation. Individual financial institutions' failure may create doubts in savers' mind regarding the stability and solvency of financial institutions in general and cause panics and possible runs on sound financial institutions. This possibility provided the reasoning in 2008 for the introduction of different deposit insurance guarantees across the world. At the time of their introduction of these deposit guarantees, governments were more concerned about the possibility of contagious runs rather than bank failures. Although regulation may be socially beneficial, it also imposes private cost or a regulatory burden on individual financial institution owners and managers. For example, the Australian Prudential Regulatory Authority, APRA, sets a limit of 25% of the capital of an authorized depository institution for any credit exposure to any individual borrower, even though the loan may have a positive net present value to the bank. Consequently, regulation is an attempt to enhance the social welfare benefits and mitigate the social cost of the provision of financial services. The private cost of regulation relative to its private benefit for the producers of financial services is called the net regulatory burden. The regulation of financial institutions primarily aim to uh, prevent unfair practices and also ensure soundness of the overall system. Six types of regulation seek to enhance the net social welfare benefits of financial services. For example, safety and soundness regulation, monetary policy regulation, credit allocation regulation, consumer and protection regulation, investor protection regulation, entry and chartering regulation. I will now briefly discuss each of these regulations. First of all is safety and soundness regulation. To protect depositors and borrowers against the risk of financial failure, regulators have developed layers of protective mechanisms. These mechanisms are intended to ensure the safety and soundness of the financial institution and thus to maintain the credibility of the financial institution and thereby the financial system in the eyes of its borrowers and lenders. For example, in addition to the Financial Services Council, which protects Australian deposits up to 250,000 under the Banking Act, the Central Bank of Australia may use its power for the protection of the bank depositors. The first layer of protection consists of requirements that encourage financial institutions to diversify their asset portfolios. Australian banks are required to report large credit exposure um, to APRA, Australian Prudential Regulatory Authority. For example, Bank loans that represent more than 10% of the banking group's capital must be reported quarterly to APRA, and a bank must receive approval from APRA before entering to an exceptionally large exposure. The second layer of protection concerns the minimum level of capital or equity funds that the owners of financial institutions need to contribute to the funding of its operation. For example, regulators of depository institutions and insurance companies require a minimum ratio of capital to assets. The third layer of protection is the provision of guarantees, such as the Australian government's FCS for small Australian depositors up to 250,000, I discussed previously, and a similar scheme for general insurance policyholders. The fourth layer of regulation is monitoring and surveillance itself. Regulators subject all financial institutions, whether banks, building societies, or credit unions, superannuation funds, insurance companies, mutual funds, securities firms, to varying degree of monitoring and surveillance. Supervision involves on-site examination as well as regular reporting by financial institutions on a timely basis for off-site evaluation. Finally, note that regulation is not without cost for those financial institutions regulated. For example, societies regulators may require financial institutions to have more equity capital than private owners believe is in their best interest. Similarly, producing the information requested by regulators is costly for financial institutions because it involves the time of managers, lawyers, and accountants. Monetary policy regulations. Another motivation for regulation concerns the special roles of bank play in transmission of monetary policy from the central bank to the rest of the economy. The implementation of monetary policy um, in Australia is conducted by the Australia Central Bank, and the process is well defined. The challenge is that while the central bank directly controls only the quantity of notes and coins in the economy called outside money, the bulk of the money supply consists of deposits called inside money. In most countries, regulators commonly impose a minimum level of required cash or near cash reserves to be held against deposits. Some argue that imposing such reserve requirements makes the control of the money supply and its transmission more predictable. Such reserves also add to an financial institution's net regulatory burden if they are more than institution believes are necessary for its own liquidity purpose. Credit allocation regulation supports the financial institutions lending to socially important sectors such as housing and farming. These regulations may require a financial institution to hold a minimum amount of assets in one particular sector of the economy, or alternatively, to set maximum interest rates, prices, or fees to subsidize certain sectors. We find examples of asset restrictions in the United States, where the qualified thrift lender test requires savings organization to hold 65% of their assets in residential mortgage related assets to retain a thrift charter. Examples of interest rate restrictions are the laws in many US states, which set the maximum interest rates that can be charged or mortgages, on mortgages and or consumer loans. Next one is consumer protection regulation. With the point that in most countries, consumer and investor protection regulations are administered by different agencies. In Australia, the Australian Securities and Investment Commission, ASIC, is the regulatory authority that, among other things, is responsible for consumer and investor protection in the financial system. The broad consumer and investor protection provision are set out in the Australian Securities and Investment Commission Act 2001 and administered by ASIC, including provisions prohibiting misleading and deceptive conduct and unconscionable conduct with respect to credit facilities. Last of all is entry regulation. The entry of financial institutions to the market is also regulated. Increasing or decreasing the cost of entry into a financial sector affects the profitability of firms already competing in that industry. Thus, the industry is heavily protected against new entrants, thereby high direct costs and high indirect costs of entry produce bigger profits for existing firms than those industries in which entry is relatively easy. In addition, regulations define the scope of permitted activities under a given charter. The broader the set of financial service activities permitted under a given charter, the more valuable the charter is likely to be. That's all of our discussion for financial institution regulation. Thank you very much for listening.